Why do top 1% crypto traders earn 10 times more money than the bottom 99%? Why can one trader make trades like this, and this, and this every week without fail? I'm gonna reveal his exact strategy because I've studied the greatest crypto traders for years. And what they do, it's surprisingly simple. It's not even like a genius strategy. It's easy and it's just the safer way to do things. I'm just surprised that no one has made this video before. The first thing that you've got to understand is there's a crypto paradox working here. And it works like this. People see huge amounts of money being made on these hyped up coins. They hear 5x, 10x, 50x, and they start seeing screenshots of life-changing profits. So they look for the next hyped up coin. They jump in, and they lose thousands of dollars, like every single time. This is the story. They lose even though they did the exact same thing that everyone else did. This is the crypto paradox. Massive fortunes are made by hype, but massive fortunes are also lost by hype. The line between the two, it's razor thin. It's hard to even make the distinction between one side and the other. So there's a game here with clear winners and clear losers. To win the game, you can't fall into hype, but at the same time, you have to counterintuitively learn how to capitalize on hype without getting your emotions all haywire. You have to learn how to get on the right side of that razor thin margin. Dangerous? Yeah, maybe. Slim chance of success? The 1%ers do it consistently. And can you make money on this? Absolutely. You just have to do the right things. You have to set yourself up for success in the first place before you're in a position to make these trades or to make these investments. Almost by design, the crypto market is dumb. And I don't mean the concept of crypto is dumb or that you're dumb. I mean the market itself, it can be brain dead dumb. Like, let's be honest here. The market is based on averages of emotions. So think about the average crypto investor. Like, picture him in your mind. That is the market. The market is the average. The 99%, they're not investing fully with their brains. They're simply asking, like, is the price gonna go up? And should I hop in? That's it. Which means that most people, they just rush in on emotion only to become exit liquidity profits for the top 1% who caused that price spike in the first place. It's a dumb cycle. Everyone's been caught in it at least once. Don't feel bad if this has happened to you. We're here to learn. We're here to get better. We're here to become the 1% who is on the forefront of that price spike. So what's the alternative to the 99%? Don't do what the majority is doing. It is that simple. Most people don't look at technology surrounding these cryptos and asking themselves, does the world actually need this technology? Most people are too distracted by news and content to notice where future sentiment is obviously heading. Most people, they trade solely based on their wildly swinging emotional state that just gets 10 times worse when money's on the line. Most people have no idea why they should invest in a coin beyond its price or some meme hype that they saw on X, which is exactly why they're constantly chasing hype and falling victim to it. The 99% are not looking for anything substantial. They have no concrete reasoning why they're making decisions. They're just flowing with whatever happens to happen that day. They're not thinking for themselves. Top traders are experts at independent thinking. And this is way easier than it's made out to be. A lot of the problem here has to do with one single pesky emotion. We're gonna talk about that in a minute because first we need to chat about this thinking issue. To protect yourself from the stupidity of the market, you have to be an independent thinker. You must. This is extremely simple and it's gonna make you better than the 99%. Based on my research of top crypto performers, to get in the 1%, you must be able to take in information, analyze that information through various rules within your personal rule book, and then make a decision for yourself and be confident in that decision despite what others say. You have to make that decision, and if someone says the exact opposite, you have to go, no, I'm sticking with this because of this, and this in my rule book. The best people trust their rule book more than they trust themselves, and you'll see what I mean by that in a second, because you've probably noticed this. Most people lose money most of the time in crypto, and those that see some good returns can rarely replicate those returns. But why? They leave everything up to luck. The 99% get lucky on some trades and unlucky on more. That's just how it goes. Every once in a while, they'll see a nice big profit, but that doesn't really matter because they haven't learned anything and they can't replicate why that thing worked in the first place. They don't understand the fundamentals. And this actually gets worse if someone has multiple lucky wins, because the second win convinces them that they actually know what they're doing, when in reality, they don't. They just flipped a coin twice and it landed on heads twice. And then just bad decisions follow. That's when you double down and you have even bigger losses.
Stop it. Get some help.
So we know a few things. First, there's a game being played here with clear rules and clear winners and losers. And second, to win the game, you have to understand the game. And more importantly, you have to constantly work to become a better player at this game. And third, our biggest risk in this game is our own emotions. We must recognize this. And that's where rules come in. A rule is any defined system that you use consistently despite where your emotions are currently at. A rule is decided upon when your emotions are low, but utilized when emotions are high. That's important. A rule is you at your best, essentially. A rule can be as simple as a guideline where you only trade cryptos over a 50 million market cap because that's within your margin of safety. Or it could be as complicated as some 10-step take profit strategy that you utilize when a trade is going well. The top 1% build out these rules or mental models, and they actually write them down in a rule book and they adhere to those rules. They then stress test those rules in the real world and constantly aim to improve them. That's perhaps the most important part. Aim to improve your rules constantly. Question why you made those rules, the principles behind them, and aim to improve them while simultaneously stress testing them. Here are 4 rules that I've noticed that many of the top 1% crypto traders and crypto investors use. The first one is psychological. If you get into any investment thinking you're gonna 1000x some token, you're setting yourself up for failure. You're guaranteeing that you'll feel high levels of fear and greed. This is terrible for investing. But if you go into crypto thinking that I must win 85% of all trades, you're gonna be far more disciplined and thoughtful in your investing approach. You're gonna be more focused on learning, timing, and picking rather than some hype that's going to 1000x you into billionaire status. The key difference here is expectations. Unrealistic expectations lead to obvious foolish behavior. Realistic expectations lead to controlled, intelligent behavior. So a rule for a top 1% trader might be you must have an 85% chance of winning before entering any trade. You might be sitting there thinking like, that sounds extremely hard. Like, how often am I gonna have that? Not often. That's the point. You have to make sure the stars are all aligned before you hop in so you can make money and, more importantly, not lose money. Now, the second rule here is technical. This is extremely important. Crypto, it's not exactly like the stock market. It's being traded 24/7. There's just too much information for one trader to keep up with, and this means you must simplify your scope of what you're looking at. The best investors I know, they have a defined rule that states that they trade or only invest in what they know. That's exactly what this investor does. The best investors get an extremely deep microscope level understanding of a particular problem that a crypto can solve, like smart contract technology, for example. And then if a new project comes to the arena, they know immediately if that idea, that new smart contract solution makes sense practically or not. They have this mental model built where they're like, yep, no, that's probably not gonna work, see you later. The best traders, on the other hand, they simplify trading by focusing on just a few metrics or just a few tokens. They become extremely sensitive to the price action of a particular project. And that means they can much more easily take advantage of it because they know what happens. They've been staring at those charts forever. Proof of this is how we trade on Finova. All of our best traders, they trade just a few assets. They're not all over the place. They specialize. The trader from the beginning of this video, that's Kyle. He's a Finova trader. Kyle's story is insane. He turned a $26 portfolio into $1 million over the course of several years of consistent trading. And how did he do it? By trading Bitcoin on 90% of all of his trades over several years. He became an expert on Bitcoin's price action, and he's constantly taking advantage of that knowledge. Just like this trade from yesterday. Using a few rules from his rulebook, he noticed that Bitcoin's price was losing momentum, and he set up a short position based on this data. He shorted it even though he loved Bitcoin. He's agnostic to the price, he's just there to make money. He then noticed that the price was forming a lower low, signaling to him that he needed to use another rule in his rulebook that he defined long ago. That rule told him he should move his stop loss. He called it correctly, and he started accumulating some profits, which triggered another rule that tells him he must take partial profits when certain conditions are met. So he sold 25% of his position at a 9% gain. That's amazing, but the price kept going. It kept moving in the direction that he expected, which then triggered another rule telling him to take more profits and to sell 50% of his position, now at a 29% gain. But then things turned for the worse, and the price reversed directions, breaking expectations. However, this was totally fine because Kyle had another rule in place telling him that he must always, when trading, have a stop loss set to protect his losses. That stop loss was triggered, which automatically sold off his entire remaining position and secured him an additional 25% gain. Now, as you can see, every step of this trade was defined before it happened. That's because Kyle has developed rules that tell him, if this happens, do this. And he's constantly working to make those rules better. And as you can see, there's no emotion attached to what he does. It's just a simple if-then statement that he's built up in this rulebook. Trades like this happen every single week on our Finova Patreon page. Our current members had access to that trade from Kyle in real time. That trade would have been yours if you were a member yesterday. In order to sign up, you'll find a link in the description. We only open 15 spots per week, so if you're interested, make sure to join before it's too late. And while you do that, I'm gonna uncover another rule that I picked up from the top 1% traders over the years of studying these financial masters. The third rule is a financial related one. There's an obvious saying in investing. The number one rule in investing is don't lose money. The number two rule is refer to rule number one. The 99%, they know this rule, but they completely ignore this rule. They overexpose themselves to investments, to real estate, to business, and then something goes wrong and they're completely wiped out. You see this in crypto as well, obviously. A token promises that 1000x gain, some guy puts his entire $10,000 net worth into it, hoping to make $10 million, and we all know how that ends up. So what does the top 1% do? They never overexpose themselves. Professional traders typically play with a very small fraction of their overall portfolio per trade. A typical trade could be just 1 to 3% of their entire portfolio, and never do they trade with more than 10%. The fourth rule is strategic, as in have a strategy. Top 1% traders know what they're aiming for, and they know the strategy that they're going to take to get themselves there. Here's a few popular strategies just to get your gears going. You can have a strategy that says, I will take profits from small, minuscule price changes. I'm in, I'm out, I take a small profit, and I repeat until I've made a cumulative big profit. I will not deviate from this strategy while in the middle of this strategy. This strategy is called scalping. It's super popular. Here's another strategy. I will watch the horizon. I will take an unbiased look at sentiment within the crypto space, within news, within the world economy, and the advancement in overall technology in order to better understand where the market is headed. Once I understand with a high degree of confidence where the market is heading, I will then make a long-term investment that aligns with my data, and I will not change that investment unless there's overwhelming evidence that I must change course. This strategy is called sentiment trading, and it's what billionaires and mega rich people do. They look at the horizon, they see where things are headed, and they go, I'm investing in that. They have rules for every piece of that process, and they're constantly refining them so they have a better understanding of the world and where the world is headed. Now, I've been holding off on telling you perhaps the single most important distinction between the top 1% crypto traders and the 99%. This has to do with a single emotion, one that you can actually control. You can master it. A lot of cryptos, whether they're scams, new meme coins, or genuine solid tech, have a similar launch trajectory. A big spike, followed by a crash. Happens all the time. Legitimate ones tend to climb back up after that crash, but either way, a lot of money is made right there at the start with the big spike. If you have money in one of those, it can be addictive, especially when you're seeing that price tick up and up and up. You're growing your money. You're like, oh my God, this is what we play for. How big can it go? When is it gonna stop? Am I gonna get rich? The questions, they just fill your head. You've probably been there. The thing is, you have no idea where it's going, but you hold on just to see that number keep going up. You check on Twitter, everyone says, oh, it's just gonna keep on going out. You don't wanna miss out, right? But then the sell-off happens, and you missed your window to take those big profits. The top 1% know when to take profits. It's because they've mastered a particular emotion. They understand that a profit is a profit. It's always wiser to just take it when you can take it. Which this idea, if you haven't noticed, is the not so subtle secret at the heart of this entire video. Rules and strategies help, but managing this one emotion will solve almost all of your problems. The emotion is the fear of missing out. FOMO. FOMO is the enemy of the 99% and the friend of the 1%. FOMO makes you burn money without a clear strategy. FOMO makes you go all in on one risky token. FOMO stops you from taking profits when you know you should take profits. You're afraid of missing out, so you make terrible choices over and over again. Managing FOMO will help you make more money than 99% of people because you won't be losing it all the time. Pair that with rules in your personal rulebook, and you're gonna be unstoppable. It's that simple. Now, I was only able to cover a few trading strategies in this video. If you're really serious about becoming a 1% trader and learning all of the rules to apply to your rule book, check out this video on screen.